Hello, everybody. Good morning. Can anybody hear me? If you want to type in over here, we got that chat box going on the right side. Just let me know. We'll wait here another couple of minutes as people file in. Give it a couple minutes here. If you guys can hear me, go ahead and hit in the chat. I've gotten a couple of those private messages, which you can do on the chat box. You just hit send to admin only, and only Eric and myself will see it. So otherwise, if you leave it set to everybody, then everybody that's on the call will be able to see it. So we'll just go ahead and give it another minute here because I know we got a couple more people that wanted to make sure they were on. Awesome. We got a couple more people letting us know they can hear us, so that's always good. If you're having any issues or if you're having any volume issues or anything, just let us know. And again, you can do that thing where you can say send to admin and it'll just be a private message to me or Eric. And as we're going through this too, if you have any questions at any point, go ahead, type them in that chat box. It's totally great too to send them just privately if it's more of like a question about your situation that you don't want everyone to see. Just go ahead and hit that send to admin. I'm going to go ahead and get started and just kind of take our time on the intro as more people are filing in. Thanks for joining us today for our presentation of the truth about annuities. We're going to cover a lot of great info on the webinar, but we're going to talk first about the number one reason that retirees purchase annuities and whether or not that makes sense for you. Next, we're going to talk a little bit about the do's and don'ts of annuities. Eric's going to hop on at that point. And also we're going to talk about why some people, like you may have seen ads from Ken Fisher or some other advisors like that say, I hate annuities. And they're partially right. I mean, it kind of depends what type of annuities. We'll get into a little bit more of the specifics about the pros and cons of each type, but they're really only partially right. So a little bit of housekeeping on the front end here. Questions are absolutely encouraged. So again, if it's a general question, go ahead and just type it into that chat box over on the right side of the screen. If it's more of a question about your situation, you can still use that chat box, but just make sure it's set to admin only. So what that'll do is it'll just message Eric and myself so that only we'll see the question and no one else will see the question. Also, just for joining on the webinar today, you're entitled to a strategy session. We're going to also offer a 16-point annuity inspection, which is really cool because it basically we pop the hood on an annuity and we go through all the different areas of it, from the fees to the way some of the performance works, to the tax implications, the state implications, all the different aspects of an annuity. And we're going to offer that to anybody on here as well. And that's a session, obviously, one-on-one with myself or Eric. And also, it's Annuity Awareness Month, so that's pretty cool. The month of June is Annuity Awareness Month, so that's kind of why we were promoting this webinar throughout the month. Moving on, here's the number one reason that retirees purchase annuities, and does that reason make sense for you? So why do retirees buy annuities? Well, first off, the recent interest has been pretty off the charts. In fact, according to Google Trends, 370% more people Googled the term annuity from basically February to May than the previous 6 months combined. So again, you had 6 months versus 2 or 3 months and 4 times more interest right around that market volatility. So what are people looking for? Well, the number one reason that most people buy an annuity is safety. You know, some people say, oh, income, they want income, but really what they want is safe income. So the key word here is safety. And not all annuities are created equal. There's pros and cons. Some annuities are better than others, and some annuities work in one person's situation that would not work in another person's situation. So it's very custom based on you and your situation of what's going to be the right fit for you. But the two primary types of annuities that are out there, the two primary reasons that if you're in retirement or near retirement that you're thinking about annuities, you're probably either thinking about looking for safer income, so you want some sort of stable income stream, or you're looking for like principal protected growth. And those are really the two reasons that people buy annuities. And the income annuities, though we don't, across the board say that they never fit. They do fit for some people in certain situations, and we've recommended them. We definitely are much more inclined to use accumulation annuities for the majority of people, and we'll get into kind of what that means in just a few minutes. But overall, so if we zoom way out, the three main types of annuities, number one is a variable annuity. So over there on the left, and just so you guys are aware, that's like 85% of all annuities that are ever sold in the United States are variable annuities. By far the most popular, the highest compensation. And basically, this might surprise you, but we believe that a variable annuity is just never a fit. So we'll get into a few reasons why. We'll show you in a few minutes. But as fiduciaries, we can't really find a reason that a variable annuity would be useful. It's kind of like you take all the market risk and pay a giant fee is kind of what it boils down to. So we'll kind of share some of the numbers behind that in just a few minutes. But then number two, the next most common annuity in the middle there, the yellow money, fixed annuity, that's basically like a CD alternative. And again, we'll get into some of the specifics on the rates and things like that. But then on the right, we're going to talk a little bit later on about indexed annuities. And within that, kind of what are some of the pros and cons to each type. But let's start out with variable annuities. So the way that a variable annuity works is you're trading a lump sum of money. So you have your nest egg that you've been working for. You're basically giving that to an insurance company, and you're buying a stream of income on the back end. In the meantime, you have participation in the market. So if the market goes up, you get whatever the performance is of that contract. But if the market goes down, you also are going to take the ride down in the market as well. So it does come with some tax advantages. And I would say in the past, the reason that we've looked at variable annuities has been when people have some advanced tax planning and estate planning needs, because a variable annuity is tax deferred. So at least at a bare minimum, if you have a bunch of money sitting in like an individual brokerage account and you're getting taxed to death, getting 1099s and getting, capital gains and gains distributions and dividends and stuff like that, a variable annuity could help there, defer it. But with some of the recent changes, specifically the Secure Act back in December, we've kind of come to the conclusion that due to those changes in tax code and estate planning law, that a variable annuity is not really going to be a great fit anymore. Whether you're using it for income or growth, at this point, there's just better options out there, in our opinion. So why am I so negative on the variable annuity side? Well, number one reason is just the limited investment options. So inside a variable annuity, if you put, $200,000 inside a variable annuity, let's say, you're only going to get choices between that annuity company's fund offerings. So sometimes that's only 4 different funds. Sometimes it's a little bit more than that, but regardless, the variable annuity world tends to run pretty expensive. So we have here, this is a stat from Morningstar, the average variable annuity, 3.6% expense ratio. So we have a graph coming up that'll kind of put that in perspective of just how huge of a fee that is. Also with a variable annuity, you can lose money. So if you put your money in, you put 200,000 in, and your investment options in there cut 50%, you only have 100,000 in there that you could walk away with today. Now you might have the same income guarantee on the back end, but our point being, you still took a giant principal loss. Your heirs still lost that value. And if you designate for income, so if you use any of the things out there called like a rider, then your investment options become even more limited. Sometimes they'll only let you invest in like 40% stocks, 60% bonds if you have an income rider attached. So even though it's the most popular, I really don't see a reason why a retiree would ever use it. If it was me or my parents or grandparents or so, I can't come up with a situation where I would ever like a variable annuity. And that wasn't the case a year ago, but times change. So things have definitely changed on the legal front. So here's a really, really interesting graph. So this is a variable annuity with a 3.5% fee. And the blue line there is if you just bought the S&P 500 in 1990 and you held it for 30 years. So you put 100,000 in the S&P in 1990. 30 years later, you have 876,000. So that was a pretty good run in the market overall. I mean, there were definitely dips. There was the tech bubble. There was 2008, and then 2018, there was a good shot you're seeing on this graph as well. But that's with no fee. Okay, so even in an index fund, you're going to pay a small fee. You might be a little bit behind that 876 number. But look at what happens if you're in a variable annuity paying a 3.5% fee. Okay, that's that red line down here, and you end up with just let me make this a little easier to see. You end up with just $308,000 after fees. So, I mean, this person lost $500,000 of value just in paying fees on a variable annuity. So obviously we pride ourselves on our fee transparency. And if you visit our website or our pricing page, we're right around 0.5% on investment management fees. And that's total. That's the fund fees and everything. So I don't understand why for the same amount of risk, someone would pay up another 3% just to have that variable annuity. But that huge expensive situation there on the variable annuity side. So next we're going to talk about something that if you talk with us and you have a very, very low risk tolerance, like you're extremely conservative, you never want to lose money, period. This could make sense. We don't recommend them often, but I mean, they are definitely something that we wouldn't across the board say no, like a variable annuity we would. So with a fixed annuity, think about this like a CD alternative. It's basically a fixed rate for a fixed period of time. Your principal is guaranteed. So, if you put 100,000 in, on the back end exactly what you're going to have. It's not just that you're going to get your principal back. Like if you do, let's say you had a 1-year MYGA at 3%. And MYGA, by the way, I should clarify, MYGA stands for multi-year guaranteed annuity. So if you had a 1-year rate of 3% and you put $100,000 in, at the end of that year, you'd have $103,000. And you just know that coming into it. You know exactly where you're going to end up at the end of the period. So not only is it principal guaranteed, but fixed rate, exactly what you're going to get. Great alternative to CDs. We did a little bit of research yesterday, and the best 5-year CD is at 1.5% and a 3-year MYGA right now. So the shorter period is at 3%, and that's compounded per year. So if you put $100,000 in, you'd have more than $109,000 at the end of the period. Fees on these annuities range from 0 to 1.15%. So again, that's just a plain Jane fixed annuity. 0 to 1%. All of the fixed annuities that we would ever recommend would have no fee. So you want to make sure there's tons of no fee options that are really solid. So I would always recommend on a fixed annuity, you just try to look for one that doesn't have a fee, no matter who you're getting that through. Again, a MYGA, multi-year guaranteed annuity, is generally going to be 1 to 2% a year premium, where you're going to earn extra interest over a CD. We've just seen that over 20 or 30 years. MYGAs just tend to outperform CDs. So let's move on to indexed annuities. So an indexed annuity is a fixed annuity. It's called fixed indexed annuities, but just to avoid the confusion, we're just going to go with indexed annuity in this presentation. It works like a fixed annuity from the standpoint of it's totally principal guaranteed. So if you put your money in and the market drops 50%, you're fixed. You can't lose money. You have a principal guarantee. But the upside is much higher than a standard fixed annuity. So we'll show you some examples of that in just a few minutes. The fees on index annuities range from 0 to 1.15%. Again, all of the index annuities that we recommend as fiduciaries, we go out and search the whole marketplace. All of our index annuities that we use generally have no fee across the board. Now, there have been a couple times where if someone's in a very unique situation that maybe some of the income stuff really has to go a certain way and they need a certain income guarantee. There have been times where we've recommended up to I think a 1% fee, but that's fairly rare. It's a unique situation. Generally, if you're working with us, you can just ask us, hey, what's the fee on this particular contract? I'd say 80 to 90% of the time, it's going to be 0. So the expected growth on these contracts, though, are significantly better. If you have a fixed rate at 3%, I would say in the index annuity world, over that same period of time, you're looking at 4 to 7%. So we'll show you how they work in terms of how that interest is credited. But here's a pretty good example. So this is a real contract. Started back in January of 2000. So $100,000 got put in this particular contract. The yellow here, this is the S&P 500. So this was when the tech bubble popped, and look what happened. So for 3 years, as the market was falling, this person's $100,000 stayed at $100,000. And of course, this was a no fee fixed index annuity. But then over here from 2003 to 2007, as the market was rising, this person got interest credits on their money during the period that the market was rising. And then they were up here. And then the S&P 500, we went into the great financial crisis, and 2008, 2009, it took another giant 50% loss. And of course, what happened then? Well, this particular investor that owned this contract, they went sideways from there. Now, this obviously is a really good period for illustrating how this works. but we've seen in rising environments, the index annuity is generally not going to like outperform stocks. So what I would say is don't look at index annuities as like some kind of silver bullet that are going to beat the stock market with no risk, because it doesn't really work like that. What I will say we've consistently seen, though, is that they definitely outperform bonds, especially if you're going to be holding them, 5-10 years. Pretty consistently over time, we've seen them outperform bonds. We'll share some stats on that in just a minute. But this period here, the overall example as an illustration, I think works out really well. And what you got to keep in mind is if the market's really choppy over a 20 or 30 year period, you might be getting some credits and then going sideways and be getting some credits. So if you think that we're going to have a really volatile, next 5 to 10 years, like I do, this is the type of vehicle you might be looking at, especially if there's no fee options that can get you returns that are better than inflation. I mean, that's really what we're looking for on vehicles like this. Again, I don't think you're going to do something like an index annuity and go get 10 or 20% returns. Now, some of them do have 20% credits that have happened in the past, but I would say just don't plan on it. Plan on, we're trying to beat inflation with a lot less volatility. That's the reason we'd be using a tool like this. So, critical question here. Does an annuity make sense for your situation? I would say with the market where it is right now, back in March, when the market, the S&P was down at like 2,300, if you were on our email list, you got some of the alerts where I said, hey, we think fair value is up around 2,900 to 3,000. So we were starting to buy stocks over, March and April. And that turned out to, work out. Little bit of luck involved, thankfully, but that turned out to work out. Well, now I think we're at least around fair value. I don't think I could make a case to go in and buy stocks because I think they're going to surge like they have been again over the next year or something like that. But if you think we're in a situation where you need the money, say within the next 5 to 7 years. So if you're retiring today or soon, maybe retiring within the next 2 or 3 years, or if you've been retired and you plan on spending this money for retirement income at any point within the next, again, 5, 6, 7, 8 years, I think it might make more sense to take that money out of the environment where it's in market risk and put it somewhere where you can't lose the money. You still have access to it as long as you set it up properly. We'll talk a little bit about that. But you get to take it out of the market and still have returns that are driven by the market that should at least outperform inflation. So anyway, there's a lot that feeds into this, and we'll share a lot more information as this webinar continues. But what I would ask you right now is, how are you adding safety to your portfolio right now? What are you doing right now to de-risk? And if the answer is, I had a bunch of, we had a gentleman that got referred to us last week that has made a lot of money over the last few weeks on, or I should say over the last few months on things like Carnival Cruises and, American Airlines and different stuff like that. And he's made all this money, but he's going, hey, I want to de-risk now. I want to take some money off the table. And I asked right now, if he didn't meet us, what his plans were for doing that. And he said, I was thinking about maybe buying like Apple and Microsoft. And while I agree that they're not as aggressive as some of these companies that are like really beat up right now, what I would say is a stock is still something that can lose 50%. Even a stock fund can lose 55%. I mean, we've seen it in the past, even numbers higher than that. So I would say, it's better to own, the whole S&P 500 than an individual stock. But in a retirement income situation, you're not really taking that much risk out if that's all you're doing. So then you're left with options like bonds or CDs or, bank accounts or whatever. And I really believe that an indexed annuity is a better alternative than like bonds or CDs. So again, we're not saying they're going to beat stocks. I actually don't think that's going to happen. There might be years where that happens. But overall, what you're trying to do is, number one, beat inflation. And number two, protect principal. You want to make sure that you're growing your wealth with inflation, but that you're not losing it. So what this always comes back to, if you've been to any of our presentations, you've probably seen this diagram before where we talk about, the ABC planning model of yellow, green, and red money. Yellow money over on the left, that's like checking, savings accounts, money market CDs, things like that. And then you have red money over on the right, that's things like stocks and bonds. And Eric will do an example in just a couple minutes. Most people that we meet right now, the way that they're planning is they have a lot of their money over on the red. So they have, 70, 80% of their money over on the right side in stocks, bonds, and mutual funds. And then they're scared of kind of how volatile that is. So they take a chunk, usually a significant chunk of money, and they hold things like CDs and cash. They have big money market funds, they have big CDs, stable value funds in their 401k, things like that. And they might be in a situation where they have 70% of their money in the market, in the red money, and they have 30% of their money over in the yellow. And to us, I think they're really doing a disservice to their plan. And you'll see in just a minute here, Eric's going to go through a projection where he's going to mix in some green money, which is an index annuity, and show how that is going to affect their plan. So think about right now in your situation, how much of your money do you have over here on the right side? How much of your money do you have that is at risk in the market? The upside to red money is very nice. You could get 30% over in the red money category, but you could also lose 30 or 40 or 50%. So there is that risk that goes there. And then on the flip side, you have the yellow money over on the left. How much do you have in cash, money markets, CDs, savings accounts, different stuff like that? And then how much do you have in the middle that has a principal guarantee but has outperformed inflation over the long haul? And just kind of get a feel for that, because when Eric goes through this example, I think the example is going to apply to a lot of the people on this call. So I want to make sure that you're tuned into your own situation. So at this point, I'm going to pass it over to Eric, and I'm assuming a lot of the people, just the names I've seen of people that are on the call right now, you've probably seen enough that Eric doesn't need much of an introduction. So he's awesome, and he's going to run with this. Eric, are you?
Yeah, can you hear me?
It sounded like I couldn't hear you for a second, so I just wanted to make sure. So I'll
Perfect. All right, let's go ahead and get into it then. So yeah, we've been talking a lot about the theory behind, and haven't shown this theory translate, this philosophy translate into actual tangible results. So let's go through a few examples. I'm actually going to turn my camera off here just so you guys can fully see this table. But we have on the left side here, I'll bring up this whiteboard, we have the S&P 500 returns from 2008 to 2018. Okay, we're going to go through two examples. Somebody that, a common occurrence, somebody coming into our office that they have money in that yellow money category, they have money in the red money category, and they don't really have any money in that green money category. And we're going to show it through a period that you'd expect actually this first example with more in the red money category to do well. I mean, this has been one of the longest, strongest bull markets since 2008, since the crisis of 2008. And so in this example, we have somebody with 30% in that yellow money category, and we have somebody with 70% in this red money category. Okay, $1 million portfolio. Okay, and so when they're invested, when they're in the accumulation phase, they're not taking any money from their portfolio. We see that a 30% allocation to a safe money allocation ends up helping a little bit. But if you notice here, 2008, $1 million portfolio, year one after 2008, turns into $750,000. So it's a big loss, almost unavoidable if you have any strong allocation to red money. But notice here that they spend 4 years underwater. And so it's easy when we step back from this and just from a bird's eye view, look at this in 10 years. But think about if this was your portfolio, you're seeing $250,000 eliminate just like that. But you're also seeing 4 years underwater where you had $1 million portfolio and you're not even coming close to that for 4 years. And so that can be extremely stressful. And we're going to show in a second too how when you add income, taking income from this, it gets even more stressful. But we notice even despite this 2008, $1 million still turns into 1.9 million. So still great growth when you're in the accumulation phase. However, it can be scary for anybody that actually lives through this, understandably so. So can we build a better allocation by allocating differently? Can we build a better path, I guess? And if we switch up the allocation and we go 5% into yellow money, and we still need that protection, but we want a little bit more growth from that protection. And so we're going to put 35% in green money, which means we're going to be taking 10% from the red money. And so we're taking 10% from what's supposed to be the highest growth vehicle. But interestingly enough, because of 2008 and balancing out that risk and growth, we see that we still get hurt. Okay. Again, it's hard to avoid something like 2008, as strong and as violent of a crash that we saw. But notice here you spend 2 years underwater versus 4. Okay, and notice when we zoom out and fast forward all the way through the 10 years, rather than growing to 1.9, it grows to over 2 million. And so this is an interesting case study because it shows you that you can actually get better growth by adding safety into your portfolio, which is hard for some people to grasp, but it's completely true. Let's go through it from an income scenario. Let's say we're taking 4% from our portfolio, and we're growing it for inflation. Let's just assume inflation's 2.5%. Okay, well, you see here in that first example, 30% into yellow money, 70% into red money. We see a lot of red years here. Okay, so we're not only losing money from the stock market here, but we're also taking $40,000 worth of income. Okay, and that's growing through inflation. So notice at the end of the 10 years, you're taking 51,000. And so you can really see how inflation really weighs down on the income that you're taking. But you spend a lot more years here underwater, seeing that $1 million portfolio kind of fade away. Now, still, we grew it over this 10-year term. But what happens if we make that safer, more balanced allocation? Well, interestingly enough, once again, we still spend years underwater. Okay, a 2008 type event will do that to you if you have an allocation to stocks. But notice we build a safer portfolio for taking income from, because we spend a lot less years underwater and we actually still grow our money throughout this period. And we add about $200,000, again, just by switching up the allocation. And so hopefully this helps this whole idea become alive and shows how powerful it can be. But let's talk about some do's and don'ts around annuities and which annuities you should stay clear of at all costs. I think we've already kind of alluded to that, but don't purchase an annuity with a fee most of the time, okay? And especially when we're talking about a variable annuity, be fee conscious, okay? If you are part of our email drip, you saw yesterday, we've been very heavy on talking about fees lately because most people see a 1% fee and they don't realize when you compound that over years how much that fee can make a difference. There are no fee options when talking about annuities, and so you can choose to not take a fee. And why would you? All income annuities have fees. So again, we've recommended income annuities in the past for people it makes sense for. However, we're going to show one of the mostly don'ts is not choosing an annuity with an income rider, and that's partially because of the fee. Notice here, fixed and index annuities qualify as having a no fee option, but example expenses for a variable annuity on the right side here, you have M&E charges that are 1.25%. Okay, a death benefit, M&E is mortality and expense charges. Death benefit of 0.75%, an income rider of 0.75%, and then you have the fund fees. So when you put that money in a VA, you're still investing in mutual funds that carry a fee. And so these add up. Again, it's not uncommon for us to see well above 3%. Like you saw on one of the last slides we had, the average fee is, I think it was 3.61% nationally, and that's according to Morningstar. If you're looking for a CD alternative for whether you have you want that money to grow, but you need it in 2 to 3 years and you can't lose any money from that, or whether you're just looking at a CD to add safety to your portfolio. Right now, CDs from banks are atrocious. Okay, we like to, rather than certificate of deposit, we like to call them certificates of disappointment. Okay, I mean the national average for a CD right now is 0.5%. The national high is 1.51%. Now it does have FDIC protection if the bank does go under, but you're paying taxes on it each year. Okay, so after you factor in taxes and inflation, most of the time we've seen CDs lose purchasing power. And then liquidity, you really don't have liquidity. Versus this MYGA option, multi-year guaranteed annuity, national average right now is 1.84%. The national high for a 5-year MYGA right now is 3.8. And so we compare that to 1.51, and we're seeing double the return from CDs from insurance companies. I don't want to get super in depth into it, but it does have some layers of protection. Okay, there is a reinsurance fund basically that annuities, if an annuity company in Wisconsin goes under, all the other annuity companies are basically obligated to take care of their annuity recipients. And so there's still a giant level of protection. You get tax deferral. So rather than paying taxes each year, you can defer it to whenever you choose, basically. And then liquidity, you do have partial liquidity. And so MYGAs on just about every front are better than CDs. And so do use a MYGA in place of a CD. And again, mostly don't. So we have clients that, I'm sure we have clients on this call that have an income annuity. It does make sense in their situation. That's why we recommend it. However, for the majority of people, it won't make sense. Okay. And a big reason why is because of taxes. Okay. And so if you're making Roth conversions in a given year, if you're trying to avoid the Social Security tax trap and you have, let's say, $20,000 coming from an income annuity, well, you essentially have to take that $20,000, whether it makes sense for your situation or not. Maybe one year it makes sense for you to take from your Roth IRAs and totally avoid paying taxes altogether. Or it makes sense to take portions from your IRAs, portions from your taxable account. I mean, basically an income annuity can mess up a tax situation. They typically don't adjust for inflation. And so you need to adjust for inflation in different parts of your plan if you do have an income annuity. And then in a sense, you are giving up growth. Now you're guaranteeing income. Okay. You're guaranteeing that you have that, let's say $20,000 of income for the rest of your life. And so you understand going into it, the trade-off that you have. But if we see a hyperinflation, or we see, if we see the stock market go on a roaring 80s type run, okay, you're going to be giving up growth, and you're giving it up for safety, but just understand what you're giving up. Okay. Another one is do use annuities for safe withdrawal and income. And on the screen here, I have kind of two options. Let's imagine for a second, this purple line is if you put all your money in the stock market, okay? You can see it's kind of a roller coaster ride. There's a lot of volatility. And let's say this green line is allocating a portion to a safe growth type of an accumulation annuity, okay? Well, given the choice on the purple line here, would you want to take income here, or would you want to take income down here? Okay, you'd obviously want to take it at the high of the market, right? But we know that bills come each and every month on a fixed period, okay? If a 2008 happens, we don't have the option to stop paying our bills and say, hey, we want to wait till the market comes back, then we'll back pay our bills, okay? No, you have to take income during less ideal times. Versus if we look at this green line, would you rather take income here or here? Okay, it doesn't matter as much. And so, especially when you're in retirement, adding safety to your portfolio can increase your overall probability of success and increase your ability to withdraw safe income. Okay, so that's where we think from an annuity standpoint, how it can provide safe income without guaranteeing that stream of income. Okay. Now, don't use an annuity. I'm just going to move my head here again. Don't use an annuity that doesn't have a death benefit. And so this is one of the biggest objections when we talk about annuities. You have an income rider that's guaranteeing you $20,000 a year for the rest of your life. And so at the beginning of retirement, let's say you exchange $300,000 for that guarantee of $20,000 a year. Okay. Well, if that doesn't provide a death benefit to your heirs, okay, and in the first year of retirement, you and your spouse get hit by a car or something, well, that $300,000 just goes away like that. Okay. And so you've saved up you've worked hard, you've saved up money, you've taken risks in the market to earn that $300,000, and then it's gone at a drop of a hat. And again, that's a low probability scenario. However, if it's something that happens to your situation, it's going to really matter. And so use an annuity that has a death benefit. I will say this is more of a thing of the past. Most annuities, whether they're income, VAs, anything, now have death benefits. But make sure that your annuity, if you have one, has one. And so use annuity for diversification. We've shown this on the last few webinars, but basically, where are the safe havens? We've shown that diversification hasn't consistently worked, especially in the last 20 years. And it's because of this global economy. Everything's moving together. Okay. Everything's interconnected. Well, from March 9th to March 20th, during this time period, we saw just about every asset class go down. Even bonds weren't safe. No matter where you were allocating, even cash money market accounts were going down. Well, the one thing that didn't, besides for inflation for those 2 weeks, is green money annuities, okay, completely protected. And so again, they didn't necessarily grow, but they added that safety to your portfolio. And so if we're looking at diversification, again, I would make a case that green money annuities have a certain level of diversification you can't get elsewhere. And also, don't use an annuity that caps your growth. So some fixed index annuities have some weird, complex ways that they figure out how much they return back to you. Some of them are what's called a cap. And so basically, if you have a 6% cap for an annuity, it means that in those up years, you can only earn up to 6%, the first 6% of performance. And so if we just look over the last 5 years, you see in 3 of those, well, I think it's 6 years here, 3 of those 6 years, you were giving up significant return by capping your growth. Now, you were still getting those 0%, that 0% principal protection in these type of markets, okay? But you're giving up that growth on the upside, and you just don't have to. And if we see a world of hyperinflation, okay, and we see, and again, I don't think we'll see super hyperinflation like the Weimar Republic, but theoretically, if we did, and you're capped at a 6% growth, you're participating in the stock market, but you're only participating up to 6%, where you could have a much higher inflation hedge. Tony, do you have something to add on that?
Yeah, I was just going to say, I don't know if this is going to show up. I might just have to read it off, but these are the caps right now that we're seeing out in the market. So it's like 1.8 to 4.75. And that's just because interest rates are down so much. So Eric's being very generous here when he's showing one with a 6% cap. A lot of those caps are like 3%, 4% right now. So we don't use capped annuities. I don't know that I've ever used one, but a lot of advisors will recommend those. And I don't really get why, because if I have a 3% cap versus I could go get a 3% guaranteed rate from a multi-year guaranteed annuity, I don't know why I would do that, but it's, I think sometimes they maybe just don't know all the options that are available, but the caps today are even lower than this. So I just wanted to add that.
Right. And the other, rather than a cap, another term you might hear is a spread. So there's kind of participation rates when dealing with fixed index annuities. You have participation rates. So that would mean, let's say the market goes up 20%. If you have an 80% participation rate, okay, you get 80% of that upside. If you have a cap, we obviously just showed this here, but then the other term is a spread. And so let's say you had a 6% spread. Well, that basically means you wouldn't get the first 6% of return. You get everything after that. And so in these examples, you basically be flipping it on its head. Rather than getting 6% in here, you'd be getting 3.54%. And rather than getting 6% here, you'd be getting 13.42. So even a spread makes a lot more sense than a cap. I don't think anybody should ever use a cap. So that's a big don't. And then topic number 3, why some people hate annuities and why they're partially right to. Okay. On one side, you see people really critical of annuities. You've probably seen Ken Fisher there on the left. I hate annuities and you should too. What's interesting for him, he runs one of the biggest investment planning firms in the country. And he charges his clients, Tony, you might know better, but I think it's 1.7%.
Yeah, it starts.
So of course he hates it.
1.5. It goes down from there, but a lot of his clients are paying like 1.2.
Okay, and so of course he hates annuities because he's earning a higher. He's earning 1.5% each and every year, and so why would he want your money locked up in an annuity? And so always understand there's different conflicts of interest. From everybody's side, okay? Nobody doesn't have a conflict of interest, but there are opinions on both sides, okay? We can show you professors, PhDs, Nobel Laureates, basically showing how annuities are a very unique asset class and can provide safety. Ben Bernanke, for instance, owns as majority of his net worth in annuities. So we used to have on our presentation.
Not to interrupt, it's outside of his house and his checking account. It's 100% of his wealth is in annuities.
Right. So the old Fed chairman, he has this smug grin that back in 2008 in a clip that we used to have on our presentations. And that smug grin was because he had annuities. He was protected from 2008. And so anyway, there's opinions on both sides. Morningstar founder and Yale professor basically did a giant study looking at fixed index annuities versus bonds going back to 1927. And I want to kind of show you long-term government bonds right here at 5.32%, and then fixed index annuities. And he showed basically over the last 100 years that fixed index annuities in every type of market environment basically were outperforming government bonds. Now notice they're not going to outperform stocks, and that's all right. That's not why we're adding them to our portfolio. We're not adding them for crazy growth. But notice here, and now we're at a point where this government bonds, this situation is going to look a lot worse, because we're at a point where we're at the lowest interest rates we've ever seen, and they're either going to stay the same or they're going to go up. And when bonds go up, they lose money. Back in the 60s, going into the 80s, we saw bonds lose 60% of their purchasing power because of rising interest rates and inflation. And so if we see that again, we're going to see fixed index annuities wildly outperform, I believe.
Yeah. The other thing I was going to add, we have his study. So if anyone wants to see his white paper, we have that. We can send it over. But he used very conservative numbers on the annuity side. I mean, in some cases, it was like, you were getting 20% of the upside of the market, when right now we have people getting much higher participation rates than that. So he used very conservative numbers, but that, like Eric mentioned, that was also a period where bonds did really quite well overall, because pretty much across that whole period of time, interest rates were coming down. So it's kind of making bonds look a lot better. And in the paper, he breaks down like rising interest rate and falling interest rate environments. And in the rising interest rate environments, index annuities did much better than bonds, much, much better. So I just want to make sure that that's clear, that I wouldn't recommend something that I thought was maybe 0.5% better than the alternative. We think going forward, it's likely to be a lot more.
No, that's a great point. Thanks, Tony. And so who's right? I mean, both are right in a sense. And so Ken Fisher, mostly when he has those I hate annuity ads, I mean, he says annuities, but that's like saying I hate ice cream. Okay, what he really hates is the flavor of chocolate. Okay, he loves vanilla, but he hates chocolate. And so he's partially right. He definitely craps on a lot on VAs, and I think he makes a lot of good points on that. But on the flip side, the group that thinks annuities deserves a spot in your portfolio for a safe alternative is also right. And so it's like most things in life. The extremes are typically both wrong. It's somewhere in the middle, and annuities definitely aren't the perfect investment or anything like that, but they can provide some balanced safety to your portfolio. And again, in summary, annuities are like flavors of ice cream. There's a lot of different types. And so when somebody says, I hate annuities, okay, it's typically not a real well thought, okay, because there are some type of annuities that make sense. Fees, safety, and growth potential should be your main 3 criteria when purchasing an annuity. It's why VAs aren't a great fit. They're high fees. They don't offer any safety. They do offer growth, but that's only one of the 3. And so make sure that you understand each of those 3 criteria. For most, an income annuity is not going to be the best fit. Okay, for some it will be, but make sure you know what you're getting with that income annuity. And then don't wonder what an annuity looks like in your retirement. We can show you. And so if you were on our last call, we showed you, or you've been on our email chain, you've shown how we can use technology and add something into your portfolio and show you right here how it changes your probability of success. And so don't wonder, okay? We can show you with our programming. And so another thing in summary is it's my big guy's birthday, his 3rd birthday, Guss. So happy birthday, Guss. He's a big old 3-year-old, and so
you would include that.
And so it's beautiful up here. He loves being out on the boat, and so we're probably going to take him out on the boat today. But I just want to do a shout out to Guss. So in closing, though. If you're interested in talking to us, or if you have an annuity that you want us to inspect, take through that kind of oil change 16-point inspection type report, we can definitely do that for you. In the chat, you should see that. I guess you could call it an offer. You can click on claim your strategy session. And if you guys have any questions, I haven't been seeing anything in the chat, but if you guys enter questions in and we don't see them, we'll forward you an email with the answer. The future's uncertain, guys, but your plan doesn't have to be. And always remember, you don't need more money. You need a better plan. Okay. Thanks for watching. Tony, do you have anything else to add?
No, I thought you did a great job wrapping it up. I mean, the only quick thing I would add is that something like COVID, the pandemic coming through, it definitely is not something you can predict, but it is something you can plan for. And what I mean by that is if you go look through 1,000 scenarios, I think we had 10 or 15 of them that showed a 30% drawdown really fast, really early in your retirement. So, I mean, people were ready for that. We had clients that even though you couldn't predict that COVID was going to be the catalyst or the cause of all of it, you could be in a situation where you were, prepared and you had the right level of safety in your accounts. And I would say also that when you incorporate some of these elements of safety into an overall plan, that it's also going to lead to better behavior and better results. I mean, what I mean by that is, if you're the type of person that's checking the market a lot and very nervous about things, I would say it's very likely, we just saw a study that Fidelity did that 30% of their platform pulled all of their money out of stocks between February and May. Okay, and that's not a typo. 30% of the people at Fidelity pulled all of their money out of stocks at some point during the crisis. And those, of course, some of the people on this call knew that those were levels that we were buying at. But that was, again, a lot of luck involved. But all I'm getting at is, had those people had kind of the airbags that come from a safer element inside their plan, they probably would have been much more comfortable, maybe even shifting a little bit more aggressive at those prices, because they knew for the next 5 or 10 years their income was going to be totally fine. Because you don't panic when you know you're going to be set for the next 10 years. You panic when you go, man, I need this money to come out in 2 years and it's down 50%. Oh my gosh, oh my gosh, oh my gosh. And I would say that don't do yourself that disservice. Don't do your heirs that disservice. Make sure that you're in a situation that no matter what, behaviorally, you can handle the ride you're about to go on. So anyway, again, thanks everybody for joining us on a Saturday morning. I hope there was some information you found valuable on here. We're always available anytime, whether it's on the phone or if you do the strategy session and set something up remotely. But anyway, I hope you guys all have a great weekend, and happy birthday to Gus.
Yeah, enjoy your weekend, guys. Thanks a lot.